Hey guys, welcome to another episode of Market Pulse, where we focus on all the markets, not simply Bitcoin. I was a little lazy about doing this by myself, so I am joined by Tyler Jenks. I also made it back to the woods because it was just too hot in New York. So this is so much better. Let me situate here. Hey Tyler, go ahead and say hi to everyone.
Hello, everybody. Good to see everyone again. I've been waiting for this one a long time. I know Tone has too. A lot of things going on around the world. We're going to look at some major markets. It should be a lot of fun.
Yep. Let me just situate here. Hey Tyler, I know you did a show with Leah the other day, and you talked about some of the traditional markets. I saw some of it. I didn't really watch all of it. I don't know, anything you wanna point to? Not really.
Yeah, there's two or three very quick things. I called it the gathering storm. Evidence is beginning to build up worldwide that this trade situation is gaining some teeth from the perspective that it's causing a lot of confusion, and markets don't like confusion. And it's showing up in our markets over here. I called it an asymmetric risk because the Dow Jones is looking very weak. The S&P is not looking so weak, but it is not strong, and the NASDAQ is still fairly strong. That is true around the world. We're going to talk about the FTSE today, the Shanghai, probably the Japanese markets, some other markets. So I think it's important to look at a very big picture here. We're not just talking individual markets. These are all correlated, and they are not doing the right thing if you are very bullish. That does not mean I'm bearish, but we'll take a look at it.
All right, and let's get going. Before we start, we already got an interesting question. Someone says, any thoughts on the Bloomberg article about tether manipulation? I don't know if this is a new article or if it's the old article. Look, we're not going to know about the history of tether until tether blows up. It's just the way it is. And tether is going to blow up. I mean, I don't know how many times I sound like a broken record. The idea of tether is not sustainable. The idea of tether should not exist. Tether exists for one reason only: to get around moving US dollars from crypto exchange to crypto exchange. Sooner or later, the US government is not going to be happy by moving around in the hundreds of millions of dollars worth of crypto that they can easily control. So tether is going to blow up. As far as how legit tether is, I don't know, and Bloomberg doesn't know, because if Bloomberg knew, they would actually show some evidence and not speculation. And if Bloomberg had some kind of an evidence, the SEC and the U.S. Department of Justice would be all over it, and especially FinCEN. They would be all over it if there was any kind of proof. So here's how tether works. Bitfinex allows you to move your money with tether. We all know Bitfinex has had a lot of problems moving your fiat. So if you don't want to move your Bitcoin, but you want to move the value of that Bitcoin to another exchange, you convert your Bitcoin into tether on Bitfinex and you move the tether out. So as this tether moves off of Bitfinex, Bitfinex starts to run out of tether. Anytime Bitfinex runs out of tether, they go and they create more tether. So more people can sell Bitcoin and move the tether. And this will keep happening. Do I think that someone is printing tether for themselves to buy up Bitcoin? I don't think so. Do I think that all the tether is fractionally reserved? I don't think so. I mean, it's possible. I believe all of it, if not most of it, is backed. I can't prove this, but I can't prove the opposite side either. Okay, I have no idea what's going on. All right, Bitfinex has been doing some good work, and we'll see what happens. But sooner, even if tether is legit, it's going down. And when it goes down, we'll see what happens. All right, no more tether talk. Let's go to the markets. Okay, let me, I gotta move these things out of the way. Okay, I can do it like that. And this I can put here. Perfect. Okay, so my website, No More Liberty Life Trail, tonebase.com, education, learn trading is where you can get a lot of links to help you learn. Check me out at my workshops. Las Vegas should now be open for registration. Chicago should now be open for registration. It still says coming soon. Why is that? Let me hit F5. I have to do a full refresh. No, still no good. All right, I have to re-log into the website. Damn it. Nope, still says upcoming. It shouldn't. I mean, Chicago and Las Vegas should now both be open for registration. We are a go. This is the schedule. You know what? If no one signs up for Boston, there is a small probability I will have to reschedule that. But for now, Boston is still a go. I don't want to reschedule it. So please sign up, guys. All right, markets. Let's go straight to the markets. There's nothing more we can say about Bitcoin, right, Tyler? We both think this is maybe a much needed bounce because we went down so much from 10,000 all the way down to 5,800. We're still staying under my triangle. Even if we go above the triangle, I was expecting 5,000 in July, and then a bounce potentially as high as 8,000 to meet the monster death cross. Now I can't wait till Monday, because on Monday we will have a real perspective of where the 30-week moving average is. I mean, on Monday, this thing, you see how much it fell from last week to this week. So last week the price was around 9,900, and this week the price is at 9,600. So it fell over $300. I think this moving average is going to fall $400 to $500 on Monday, because we're going to remove the highest weekly close by far, the highest weekly close by like $5,000, and we're going to replace it with a close of about 6,000 and change, or whatever we are on Monday. So I think this thing is going to drop like $500. So it'll be a huge drop in the moving average. And I think if the price can pull into this death cross, it'll create a horrible, position for the bulls. And I think it'll repel the price. Ugly Old Goat has written some really good articles talking about basis, and he's actually been bullish over the last week or two in his trades, but only because of contango versus backwardation trades. He's a very savvy trader, and he's not sure if the price has bottomed yet, but by looking at the basis, he's been able to be very profitable. So that's good for him. Again, when you're a trader, yeah, go ahead.
Did you see his tweet today?
No, I haven't seen anybody's tweets today.
Yeah, he basically tweeted out saying that this is the place to take profit off the bounce.
I'm not surprised. He's been saying long since around 6,000. It looks like he published another one on Medium. He's been publishing, like he's been traveling through Russia, going to all the World Cup games. He is, of course, from Mexico, where he's been living. And he, unfortunately for Mexico, they went out to Brazil. So he may be headed home, or he may be sticking around there for the rest of the World Cup games. Yeah, it looks like he published another one. And yeah, this one's a little longer, but I'm not surprised he's calling to take profits. I give this run as high as 7,000. I can't see it going higher than that. He's probably recognizing the same thing in his basis trades, and he's getting out accordingly. Here's the daily chart. The daily chart is on a 4 of 9. So sure, I can certainly see it going up to this line, which is 7,000. And I purposely drew this arrow on the 8th of July. Now, of course, if we get to 7,000 by the end of this first week of July, obviously we're not going to hit 5,000 in my anticipated time range of the first half of July. But trust me, the probability of hitting 5,000 has not changed at all. And all this will do is potentially we can bottom later and this bear market could extend time-wise. Remember, the faster we bottom out, the faster we find that bottom, the sooner we can start going back up in the bull market. Now, Vincent disagrees with me on this. He thinks that, the time of the bear market is going to be like a year, year and a half, regardless of how fast we fall. So he's probably happy. The slower we fall, the better, because he doesn't see the bear market ending sooner if we fall harder. I do see the bear market ending sooner if we fall harder. So if we don't fall hard, then Vincent and I going to be on the same page once again as far as where all of this is going. This is going to be more of a high level stuff. There's no need to go into the short term Bitcoin charts. We had two major upswings. Let's see if we get another one. I think this bull market is running out of steam, and I don't really see much coming out of it. Tyler, what do you want to do? You want to do equities first? You want to do metals first?
Why don't we start with the equities?
All right, we'll do equities. By the way, any comments on the crypto markets? I think you and I are on the same page.
Yeah, we're on the same page. I think I'm leaning a little bit more towards Vincent's idea that this is going to take longer. I do agree with you that if it happens quickly, that will shorten the time, because I think we will come very strong off wherever the bottom is. However, to me, the fundamentals are more important. And what I mean by that is simply that I was very happy to see the number of ICOs that have gone to zero. It seems to be accelerating, and that is without direct regulatory interference. That's simply the threat of interference. But I think the biggest reason so many ICOs are failing is because of this bear market. And people are realizing what's going on. So if that accelerates, if we get another 300 or 400 or 500 in the next 2 weeks, dropping down to zero, I think that gets us closer and closer to the bottom. It's simply the realization that Bitcoin works and these other things don't.
Do we want to look at Italy at some point? I don't have the FTSE 100, but I have the Italian index. Do we care?
I don't particularly care. I like looking at the Italian bond market, but I'll just point out something very quickly about the FTSE 100. I found today that it looks to me as if it has developed a broadening top, the same way that the NASDAQ and the NASDAQ 100 did. And that's a rare phenomenon. I don't see it anywhere else. But if that is the case, then we've got one of the larger financial markets along with the US with a similar pattern. So I want to follow up on that.
All right, let's look at the FTSE 100.
Yeah, the UKX is what I was using.
Yeah, okay, we'll go to the UKX. All right, let's see what we got here. I still have the old indicators. Let's drop those. Do you want moving averages on this?
Yeah, that would probably be helpful. I didn't look at it, and I think weekly is the way to look at this one.
I'll flip it to weekly. That's not a problem.
Okay, good.
For the moving averages, what do we want? Our usual 7, 30, and 50?
Yeah, that would be great for me.
All right, let's go ahead and do that. All right, I got them in there. Now let me adjust the colors a little bit. And make them thicker. Okay, so there are moving averages. So there it is, like the cross of the 30 versus the 50 is about to happen. I wouldn't call this a broadening top, though. To me, it looks more like the S&P with lower highs and lower lows. Oh, but that's the daily chart. Sorry, let's go to the weekly chart. Oh, wait, I had them at the bottom. Hold on, if I magnify it. Oh, yeah, there it is. Beautiful. I can control it down here. 1 month, 3 month. Oh, no, that's the time. That's not, it's unfortunate. Let's go to the weekly chart. Yeah, I see what you mean now about a broadening top.
Yeah, very interesting because it's so hard to get this silly thing that when you see one, it's important to take note of it. I know I've gone back and forth on the NASDAQ. We'll look at that in a second, but I'm convinced that the broadening top is still valid on both the NASDAQ and the NASDAQ 100, even though we went to slightly higher than the original peak. But here it is on a very major market. And for the last 8 weeks, we've been coming down. The short term is headed down now. But just the pattern itself, where if you go back to about August of last year, we get the first the first number 1, and then the 2 is pretty obvious, which is your 4 red candle, and then the 3 is up with the 5 and the 6 candle at the next peak, and then all the way back down for the 4, and then all the way up. If we hadn't had that 7 that spiked up, when I do analysis on broadening tops, I like to use bar charts because the wicks you tend to overlook on candles, but that is actually the high, and it was clearly a lot higher than the previous high, which was higher than the previous high, and that's what makes a broadening top. So the question now is what happens? If we break down through the 7,400 area, which is not that far away, to me, this market has the potential of going much lower.
Yeah, it does, but I do like these moving averages supporting the price. Until the price closes below these moving averages, I wouldn't be too worried.
I agree. I agree completely. What's weird about this one is how similar it is to our markets, that you had the moving averages all the way up till the beginning of 2018, doing exactly what they needed to do. But from the beginning of 2018 right through today, they've all flattened out. And that is an indecision pattern. And indecision patterns can go either way. The tendency is going to be for it to continue in the direction it was when it went into the indecision pattern, but there's no guarantee that'll happen.
Yeah, so I'm pulling up the NASDAQ. The NASDAQ had the broadening top as well. This is the daily chart of the NASDAQ. Let's go to the weekly. This is the whole NASDAQ, not the NASDAQ 100.
Yeah, that's fine.
So this divergence is nothing to sneeze at, by the way.
No, this is very big. This is a very important time for some major markets. Why don't you talk about the divergence for a bit?
Sure. So what you have here is, and you can always like spot this divergence a mile away. Like I didn't need to see the RSI to notice it. The market went straight up and made higher highs. Now notice this was the highest high. Now this high came in relatively soon after that with a significantly lower RSI reading. And now you had a higher high than that with another RSI reading. Now this is a situation where a lot of ducks have lined up in a row because you did have a weekly 9 sell that I warned people about. It came after a 13 sell. It also got followed by a doji. And this doji, while it's not, the perfect textbook doji of a reversal, for that, you really needed this doji to be above the prior candle. You wanted it to be on an island, but it still came as a reversal candle of indecision, followed by a 9 sell. And now your RSI is significantly lower than the prior RSI reading. Your MACD is also lower than the prior MACD reading. And this sets up for some significant corrections, taking out the lows. Now, if we do take out the lows, this would be one hell of a broadening top as well. Though this doesn't really have that broadening top feel on the weekly chart, because this was it was a lower close, but a higher low. I hate that situation.
Yeah, I wouldn't consider this last high as the 5. I would still consider the 5 as the previous high, with the 1 being all the way back with that little doji at the beginning of 2018. What this is, when you go higher than the 5, is, we called it a prime in the system that we built called the Selgin system. And the prime is simply a second chance to get out of the market. And usually everyone, because you've gone to new highs, does just the opposite. So this is what we call a broadening top prime. And you can't go up forever, but you can go approximately 1 horizontal line higher than the previous high. Now, a horizontal line on this chart is how many dollars? It's $200. So a $200 move above the previous high still qualifies it as a broadening top. Any higher than that, it does not. And then from that top, which is your 9, you go out for 10 weeks with your stop. And the stop is right above that 9. And if that stop gets taken out, that's the end of the broadening top. If we continue down from here, not only is this a broadening top, but it's a broadening top prime, which rarely fails. In other words, it is very accurate in calling tops.
Right. Now having said all that, Tyler, I'm looking at this. I'm going to zoom out even a little. I want to see that arrow. Okay, so look, here is how I see it. We have a 9 sell, but at the moment, I'm still assuming it's a 1 to 4 candle correction and then back to the upside.
Right.
All 3 of my moving averages are still trending to the upside, with the smallest above the next smallest or next biggest, right? Yeah. The only negative here is the fact that the price is now below the 7-week moving average, but that happens quite often.
Right.
Okay. Now, I don't like the divergence that I see, but I'm not scared yet by looking at the NASDAQ. Like, if I was 100% invested in the NASDAQ, and there was no reason not to be 100% invested in the NASDAQ. Now, when I say 100% invested, I don't mean 100% of your trading account. I mean 100% of your intentional investment in the NASDAQ. I would have been 100% invested in the NASDAQ the week of May 28th, the week we were breaking out to new all-time highs with all metrics positive. It's possible I would have even jumped the gun. This blue line is here for a reason. And I said, upon the break of this blue line, I become a raging bull of the NASDAQ. By getting a 9, by getting a doji, and by seeing divergence last week, I would maybe pull back on this investment by 20%. Agree, disagree?
I agree 100%. In fact, that's exactly what I have done. And there's nothing on this chart that indicates anything more than that, other than if you've got the responsibility for other people's money, you're always on the lookout for things that can go wrong, regardless of what the current situation looks like. And we've pointed out two things that are worrying. One is a divergence with momentum indicators, and the other is this broadening top. Now, I've told you what can eliminate the broadening top, and that's simply to go above the 9 candle. It's difficult to get rid of the divergence, but believe me, if prices start going up, those momentum indicators will fall in line also. So it is a time to be a little cautious. This is a 1 to 4 candle pullback, but if we see a 5th and a 6th, we've got a new beast. And we've got one other piece to worry about for another 4 weeks or so. But if that doesn't occur, then you simply get back into the position and you're fully invested again.
All right, let's glance at the S&P. The S&P looks a lot different because the S&P has now made a second lower high, and the S&P is forming more of a triangle than a broadening top, like a symmetric triangle.
Yeah.
And once again, the sequential system did a great job. This is how I want to see my 913s on a doji candle, which was beautiful. I remained of the assumption that we are in a 1 to 4 week correction until I'm proven otherwise. Now, once again, my 30 week, my 50 week are trending up. My 7 week has flattened out. The price has fallen below the 30 week. We have made a third lower high, and the S&P has me maybe 60% bullish and 40% cash. The divergence is also here. So the S&P is weaker than the NASDAQ, but not by, maybe by an extra 20%.
Agreed completely. And that's the way you've got to look at these things. You don't just say U.S. stocks. You break it down, then you break it down, then you break it down, then you look at industries and you decide where to go. When we look at the Dow, we will see one more area of concern for me when talking about stocks in general.
Now this is beautiful, right? Because here you had a daily 9 at the top at the same time as a weekly 9 at the top. And that was a perfect time if you're like a short-term trader or you want to, really get the right exit on your positions. That was beautiful. And then also look at this 9 that happened to pretty much get the bottom. And these giant oversized candles now happening 1, 2, 3, 4, 5 days in a row tells me there is unreasonable amount of indecision in this market. And from a daily perspective, you really don't want to be in this market right now. You want it to tell you where the hell it's going. Because if the stock market is going to go into a bear trend, there's plenty of time for you to enter the bearish trade.
That's exactly right. And that's a great way to analyze. The Dow, the S&P, and the NASDAQ are very unique in a lot of ways, but they also share a lot of similarities, even with individual companies across all of them. But the weightings are different and all of that, and you can see the result. Now, the short-term moving average here is plummeting, and it is now crossing below even the long-term moving average.
Right. Keep in mind, this is a daily chart, Tyler.
Yeah, exactly. But what that will do is that will turn that intermediate down fairly quickly here. So there's reason to sit up and take notice. I would agree with Tone that this is probably twice as risky looking as the NASDAQ, and therefore something like a 33% or 40% cash weighting makes sense in this market.
Right. So here is the Dow Jones. The last time I looked at the Dow Jones was February 20th. Thank God for the TradingView blockchain that keeps my dates pretty immutable. And I haven't looked at this in forever. I even have it in the form of bars. Wow. It's a lot of volatility.
There really is.
That's a lot of volatility. The last time I saw this was like 2011.
Yeah.
Like even 2015, 2015 was a dead year. 2015, the Dow Jones returned zero. That was as flat as you get. But it spent most of the year in negative territory. But 2011 was this area here, and people got very scared that Europe was going to collapse, never to be heard from again. And I was on that bandwagon as well. I remember the panics of 2011. And this reminds me of that a little bit, but then we were able to right the ship.
Well, and back in both 2011 and 2015, the long-term moving average was actually touched and penetrated. We're so far above that right here on this on the chart you were just looking.
Oh, Tyler, we lost your mic as I go ahead and put the moving averages on there. I think
okay.
You're back.
I'm back now?
Yep, you are back.
Okay, good. Yeah, so basically I was just saying that in those two previous corrections, we came all the way down to the long-term moving average, the 200-day or 200 period. This one, we're still well above it. But that also indicates that you could have further to fall.
Yeah, let me just set up the moving averages. The good news is I only have to do this stuff once, right? And then it's there for good.
Right.
So I haven't looked at this in forever, so. All right. Candles or bars? What do you like?
Let's go with candles.
Wow, and there it is again. There's that 9 sell 2 weeks ago, a 9 aggressive 13 sell on the same day.
Yeah.
Now, granted, you had a 9 combo 13 here, and it topped a couple of weeks later, so not ideal according to my trading system. I mean, you could have gone back in on this monster candle, but this was just an unreasonable move up. I remember I attended a workshop at the Bloomberg building once. Bloomberg has a great technical analysis unit. They're all CMTs. It used to be, I forgot the name of the guy that used to run the unit. He might still be running the unit. Something with a C was his name. I always forget his name. And I watched like a 30-minute presentation on this entire analysis of what happens when the price rises above the 200 period moving average. I don't even have the 200 on here. I have the 50. And they had this analysis going that there is a limit where once the price of a stock goes X percentage above a 200-day moving average, you can short the hell out of that stock. And if it goes a little bit higher, you double down. And their statistics on that trade were absolutely amazing. So at this point in time, you are so far above the 50-week moving average. I can only imagine how far you are up against the 200-week moving average. So you got to be real careful here. I mean, the market was really going exponential. And
we're almost back at the 50.
Yeah, and you see this is the 4th week of 1 to 4 candle correction. So, we need to rebound from here. So like I said last week, this week is a make or break week for the stock market, but it looks like this week is going to be a monster indecision week. And guess what? If I'm getting a doji candle at the 50-week moving average on a lot of these indicators coming off of a 9 on a 3rd or a 4th week of a pullback, any strength in July gets me back into the market.
Yep. Yeah, I would agree with that. And I made the point when Leah and I did our broadcast that just because you've got a gathering storm, you've got storm clouds that are getting darker and darker and building in terms of height, doesn't mean you're going to have a storm, but it does mean that you should prepare for one. And that's all we're really saying at Lucid in terms of the U.S. stock market. They're still in very strong uptrends. The economy is strong. Unemployment is low. The tax policy has gone through and people are beginning to understand how positive that is. There's reason for the market to continue up. However, we are showing a lot of indecision patterns, and people need to be cognizant of that.
Okay, so let's talk about China. I looked at it briefly with Leah the other day, and I am very puzzled by this chart. I don't think I've ever seen anything like this. It's hard for me to do technical analysis. By the way, we're looking at a monthly chart of the Shanghai. And I'll zoom in on the weekly and then maybe even the daily, but like I would have missed, I mean, like this bubble, this 2015 bubble, it just feels so artificial. I can't explain it. That's not, I know everyone in Bitcoin wants this to happen because Bitcoin looks very similar right now, right? Because we went up like crazy into 20,000. We then had a very sharp reversal. This should have taken us back to new highs. But when this happens, it was supposed to go lower. It was supposed to bottom out. Maybe in the, it was weird. Like this fall overshot by too much. This initial fall in 2007 should have probably stopped from technical analysis perspective in the vicinity of 2250 or something like that. It should not have breached the prior highs, especially on such a fast move. Like this is clearly like I think even Hyperwave is going to have a problem with this. This is just too big of a rise.
Yeah.
Like I can't even put a Hyperwave on this.
No, and that's not, it is, you're right. That is not a hyperwave.
Right. And
that's a bubble.
That's a bubble. And this reminds me of oil. Like if I compare this to anything, I compare it to, oil of the 21st century price of oil. When it went to $150. Right. And then it went to $100. Right. But like, this is weird to me, right? Because at this moment in time right here, this move should have gone down, not up. And it went up and it failed to get to new highs. And then it did it again. And now this looks like if I didn't know any better, I'd say this thing is going to 800. Like I don't know how to analyze this. And I think my confusion, and I've been bullish on China for a long time, but not lately. I think their most recent government has destroyed the last 25 years of China opening up and becoming more free market. And I think all of that has disappeared in the last 5 years, and it's wreaking havoc on their equity markets. And to me, all of the confusion and this schizophrenic movements of their markets, I think it fits well with the concept of you don't know which Chinese companies are legit and which Chinese companies are pure bullshit.
Yeah, I would agree with everything you said. I do see one pattern here that's interesting to me, and that is you can connect all the bottoms with a line and you can connect the tops, and you've got an enormous triangle forming clear across the whole thing, which would have the potential of breaking to the upside in a very big way at 3-4 years from now. Other than that, what I'm looking at is a managed economy and not a free market. And when policy changes, you can take it almost anywhere you want to take it. And I think that's what we're looking at here is a period of time where the government allows certain excesses to take place and then steps too hard on the brake pedal, very similar to what central banks do and have done for the last 100 years in terms of taking away the punch bowl, but doing it so rapidly that you go into a recession.
Yeah, I have a better analogy for you.
Yeah.
The US has the same problem when it comes to tax policy, because every 4 to 8 years, you have the potential of a president coming in and like completely restructuring the corporate tax system. And because there is a chance that in 4 to 8 years, the tax system will be completely different, it's a little hard for companies to plan way further out. This is where Europe has a big advantage because their tax system are way more rooted into immutability than the US tax structure for corporates. Now, in China, the problem is regulation. Like the regulation in the US is somewhat, stable, which is how countries and corporations can plan for their corporate structure. Like filing, like creating your company from a corporate perspective doesn't change every 10 years. Nothing like that. And but in China, you probably have any kind of law can completely change, and that's why and markets don't move because the law has changed. Markets will move when the wrong person's in charge, and you even think that there is a potential that they might consider changing the law. You're going to adjust accordingly. So markets will move. The stock market rallied like crazy the day Trump got arrested, not because he reduced taxes. He's not even sitting in the office yet, but because there is a small probability that he's going to reduce taxes. And that is a much greater optimism for corporations than a small probability that Hillary Clinton will raise taxes. Like it changes your entire dynamic as a corporation for the next 8 years. You don't need him to raise the taxes. The speculation is already embedded right in there within the first 6 months of the Trump presidency that taxes are going to not go up.
Great point. And, this is a little bit of political philosophy, but it's very important to understand. We're looking at what I consider to be a managed economy and a managed market, and what type of confusion can come about where you have bureaucrats putting thumbs up or thumbs down at various times and the way markets react to it. The one thing about Trump that I think everybody has to begin to accept is things that he has said in the past that he will do, promises that he has made, first of all, weren't believed. Secondly, those that believed it weren't sure he could pull it off. But thirdly, he is not only trying to keep them, he is pulling them off. And therefore, what happens is corporations and individuals' confidence in what a politician is saying for the first time in my life are the same things, that what they say they are going to do, not if it's good or bad or right or wrong, simply that there is clarity about the message, no BS. And it doesn't matter if it's Democrats or Republicans, when you go back and look president after president after president, things that they said that they would do, or senators that said what they would do when they get to Washington, and it never happens. All of a sudden, it is happening. And that is the most bullish thing I could say about the market going forward.
Hey, so I'm trying to pull up the topics. I might have to go with the Nikkei.
Yeah, the Japanese markets have been throwing curveballs at everybody for a very long time. Um, and that is still true today. Let's see. Yeah, the 225 is a good example. The
Oh, wow.
225.
The Japanese, look at this. I mean, I love the sequential. I mean, it hit the top beautifully, and then
Yeah,
the second top as well. Even
right.
got the bottom fairly okay over here. A little late by a candle, but that's okay. Um,
Yeah, this is not a good looking chart. Not
um,
as bad as China, but it is not a good looking chart for one of the five top economies in the world.
oh wow! So that it topped a while ago. This is a different looking chart here. Clean it up. Yeah, so this one is I'm not sure what moving averages I'm using on this chart, but you know what? It's gone up quite a bit. Oh, this is the daily chart. We don't want daily, we want weekly or even monthly.
Yeah, it was down at around 6,500, 7,000 when it started this climb, and it's made it all the way up to 24,000, remembering that it had been up to 38,000 back in December of 1989. So it is still 40% lower than it was 20 some odd years ago. But having said that, um, it has been struggling to get above and hold the 20,000 level. It did it. It ran up to 24,000, and it's a pretty darn good looking bottom down at 8,000, double bottom. And then it's trying to work its way back up to its all time highs, but it's got a long, long way to go. And all of a sudden, it's looking pretty nasty to me.
Right. So this is a reasonable bottom for me because, well, I guess in China it should be okay also because it spent 2 years not doing much and then was able to break out. But uh man, is it ever gonna come back to its new highs?
Yeah, but I don't know if it will in our lifetime.
And the thing is, like inflation adjusted, this thing is probably like almost double that.
Yeah, exactly.
Like this chart is not inflation adjusted.
At the time, everything from the left of where your pointer is was a managed economy, and it was a managed stock market. And when you allow that to occur, you end up paying for it. No one has quite paid for it as much as Japan did, but they have paid for it with recession after recession in their real estate markets, in their corporate markets, all
But
across.
it was more to it than that though. Like the final year and a half of the Japanese bubble. I mean, the after the 1987 crash in the U.S., people were so scared to invest in the U.S. market. All the money went to Japan, and that blew their bubble to way worse than the 1987 crash, and they're still paying for it. So they got a double whammy there. Oh, lost your mic. Yep, you're back.
Absolutely, and that was the end of a hyperwave. By the way, that peak
Yeah,
at 38.
I'm sure there is a lot more data here that I just don't have on trade.
Right, right. But so what's interesting is one of the comments we make about hyperwaves all the time is not only are they interesting and you can make money on both sides of it if you know how to play it, but what is the implication of it on the world economy? To me, big things are happening when you see hyperwaves. Now, I'm not talking about individual stocks or an individual crypto. I'm talking about the whole thing, the whole package. Uh, the Nikkei was the Japanese stock market, the Japanese economy was the strongest in the world for a year and a half. They were number 2 behind the US, but they've been falling as China has gotten stronger and stronger. But the point is, when you see these things like we have done in Bitcoin, it says that something is going on that has worldwide implications. And so it's always interesting to try to step back and see what's going on.
All right, so we can move on to gold, silver, and oil, or maybe I can glance at a question or two. Let's see if there's questions worth answering, because not everybody can stick around for the whole time.
Good.
Someone is asking, what do I think about India ban on crypto? Let's try and remember that for our Bitcoin show. I don't really think anything. I think we've covered India enough, unless there's some new stuff out of India that I haven't heard yet. Now, let's look at another one. It is a silly question, I guess. What do you guys do while the market is dead, but you were hoping to trade that day? Just examine the charts for hours. Well, no, I mean, you test out other strategies and you look for, you zoom down into individual markets, right? Like not every market is dead all the time. So if you are managing other people's money, and if you have the luxury of managing individual stocks, there's always more stocks for you to look at. And if you can't manage individual stocks and you have to go into actual markets, if I'm guessing Tyler spends all of his off time analyzing sector rotations and doing a bunch of correlations to see, hey, if the market is dead, it's probably a good time to reanalyze which sectors might actually be going over others. Do I have that right?
Yeah, that's exactly right. You always start at the top. There is always a bull market somewhere. There's always a bull market somewhere within a bear market. In other words, if 8 sectors of the economy in the stock market are weak, 2 of them are not. And very often they're moving opposite. But if that's not true, you can move to another market, and there's always something that is going the other way. Why? Because money's got to flow somewhere. And all money doesn't only flow into cash. Most of it is going to look for returns. And that's why you get these wild moves between markets. And so you're exactly right. Just don't fixate on one market. Just don't think that you're going to have all your money in Bitcoin and you will ignore everything else, because you've just had a 6-month period where you could have done extremely well in a lot of other markets while Bitcoin was correcting.
Yeah, so we got 2 more questions. Tone, have you noticed the monster hourly wicks up and down? Were they present back in the 2014 bear market? Absolutely they were. The order books were even thinner back in 2014. Yeah, there were always wicks on the hourly charts. A lot of it is done on purpose to knock out your stop losses by traders with more money. And here's the next question. Let's see if Tyler agrees with me here. Here's the question. What do you think about the thickness of the order book? Coinbase is showing 36 million in buys all the way down to the $5,000 mark, looking much stronger than in the past. I completely ignore the order book. To me, looking at the order book is like listening to a poker player telling you what 2 cards you can't see. That's kind of my view on order books. Tyler?
Particularly order books in the crypto world. I just can't emphasize enough how disappointed I am at how difficult it is to get the truth about anything that's going on in the crypto world in terms of prices, volumes, cap size, on and on and on and on. I take it all with a grain of salt. I'm hoping that the price activity remains reasonably understandable so that technicians can take advantage of it, because there's no way in the world a fundamentalist can make a nickel in the crypto world. The information is just too tainted.
Oh, again, another interesting question. What is the likelihood that the CME will ever add Bcash or other shitcoin futures? I believe the answer to that is the likelihood to that is pretty much zero. The CME is already running into trouble, proving that the underlying price of Bitcoin is legit. And if they're struggling proving that the underlying price of Bitcoin is legit, how the hell are they going to justify the price of any shitcoin where the volume is less liquid, less trusted, and more questionable? So that's not happening. What are they going to do? They're going to go and get Bittrex data? Come on. All right. Let's get back to the charts. Let's talk gold. Here is the monthly chart of gold. You know what? I'm gonna put another moving average on. Yeah, I gotta do these markets more often. Like, I don't get to talk about these things that often, so this is great. Let's get to the moving average. Favorites, triple. I wish it came in my perfect colors and thicknesses of the lines.
Right.
That's it. I can probably edit the code, but I'm just too busy to look at it. I do know the guy who wrote this. Maybe I'll get him to update. Okay. All right, this is the monthly chart of gold, and so once the 7-month moving average crosses below the 30-month moving average, it's not good, because that has only happened once this decade, and that was in 2013. And and gold fell hard. Now, I think once the price goes, look at the monthly chart. I think once the price goes below the 50-month moving average, which is only $20 lower, and the 7-month moving average crosses below the 30-month moving average, this thing is in a world of hurt. Like, I was always skeptical of the $1,000 bottom, 1,044, and the only excuse I was able to justify why gold may bounce off of 1,044 instead of going all the way down to 800 in this bear market. And I was a bear all throughout most of this. The only way I can justify the fact that 1044 might be a reasonable bottom is that 800 from 1980, inflation adjusted to today, is probably in the vicinity of 1100. That was the only justification I had. Other than that, if we go under 1200, my $800 target gets back on the table. Your thoughts, Tyler?
Can you draw a trend line from the 2006 through the bottom in 2017?
Yep.
I'm just trying to see. This is a funky hyperwave, but I'm trying to just picture what it's telling me. Well, one thing you've got an enormous head and shoulders. You don't want that green line to break. But other than that, the fact that that line is coming in slightly below all this moving average activity gives me some hope that we're going to find support and get back up to the 1400 level. I have no evidence of that other than just my sense of what this chart is trying to say. We did break the downtrend from the top in 2013 through that next swing top with your 9 on it. And I think that was an important break, but we have not been able to take advantage of it, but we still might if the price can hold within the next $25 to $50. What are your thoughts on that?
No, I agree. I think the $1,200 gold price is like the make or break point. Like if gold can't hold 1,200, I think there's going to be a massacre.
Yeah, I agree completely.
Like below, like a weekly close below 1,200.
Yeah,
puts $800 bear market in motion.
And I agree.
And yeah, go ahead.
And when we take a look at silver, silver is on a knife's edge also, with the potential of dropping all the way back to the $6 low area, $6 to $7.50. Not that they always move together, and in fact they don't. But right now they are both sitting in a territory in which they can move up very big or down very big, which reminds me of what we just said about some of these other markets, like the US stock market, that it looks like it can move up very big, but some cracks are beginning to show. The UK market, the same sort of thing. There's a lot of stuff in the bond market we won't have time to get to today. But what my point is that it is not a coincidence that some very big, large, important asset classes are in the middle of an indecision pattern right here.
So I gave this presentation. This might be hard for me to fit on this monitor. I gave a presentation a while back, and the presentation was at the anarchist conference, Anarchapulco. And I want people to understand that markets, like the last bear market in gold lasted 25 years. And I was saying there is a possibility that the market in the current gold price will also last 25 years. And I compared the spike to 1,400 to the spike in 1982. And this was my expected trajectory of gold. We were right around here at the time of that presentation. It was in like early 2017 or like late 2016 or something like that. And maybe this was a little bit bullish, optimistic point, but at no point am I crossing 1,400. And my potential bottom was all the way in the $650 range in the year 2032. And this took a great, the audience had a huge laugh when I talked about this. But this is very possible. This is it'll like flirt just under 1,000, then I think it'll swing up. But I just can't see gold going anywhere in the near future.
Well, to me, it's a simple proposition, not gold, but gold, Bitcoin, and central banks. If we assume that Bitcoin in the next year is going to bottom somewhere, 5,000, 4,000, 2,000, 1,000, doesn't matter to me. To me, that's nickels and dimes. I know that's not for everybody, but I like to look at the big pictures. If that were to occur and then we began a major bull market in Bitcoin, I would see this gold following your chart very closely. Just kept getting lower and lower over years and years and years and years. If, on the other hand, the Bitcoin market and the crypto market, for whatever reason, drops and does not come back, I see gold taking a very sharp move up to new highs and taking out the 1900 highs. Because to me, that leaves only one other alternative for the macro world central bank debt problem, and that is to do more of the same thing that they've been doing. There are no other alternatives available to them, in my opinion.
Yeah, that makes sense. That does make sense. All right, let's finish up gold, and we'll touch on silver quickly because I do want to get to oil.
Great.
Here's the weekly chart of gold, and you're on a 3 of 9 and on a 4 of 13 in the countdown phase. You are trying to hold the setup trend line and the prior lows. And your 30-week is going to be crossing below the 50-week sooner or later. Your 7-week is already lower than that. I think it's only a matter of time before 1240 breaks down. And there's no time to get scared about gold yet. But I think the storm that can take down gold below 1,000 is brewing, and it's more obvious than the storm around the stock markets.
I would completely agree.
Do I have a day? I don't even care about a daily gold. The weekly is good enough. Okay, silver. Let's look at silver. I mean, Saifedean has convinced me that looking at silver is almost like looking at copper. It's totally useless as a monetary mechanism.
Yeah, I don't consider it monetary at all, but I do consider it a very important industrial metal, and it's also culturally very important. And that's why I think it needs to be tracked along with platinum and palladium when you're looking at gold. The spreads between them and all of that, I don't care so much about. That's kind of archaic, but they do tend to move together in waves. And so you can get some evidence what's going on. And silver is looking pretty nasty to me.
Yeah, here's the weekly chart of silver as I have it on this. There's no indicators here. There's no moving averages here. But there are descending triangles. And we're still inside this latest descending triangle, which I can, maybe adjust a little bit now that I have a lot more data. And I don't even have to adjust it. I'm not even going to touch it.
No, it looks good. It looks good.
I haven't looked at this chart in a long time, and it does look good. And the bottom of that line is at $15.50. And below that, you are looking at a potential $5 correction, all the way down to $10. Do I think silver is a decent buy at $10? Maybe. Like below $10, you can probably speculate on silver. But it amazes me how many, crazies out there talking about how silver should be worth $5,000 an ounce.
Right. And if you believe gold is at some point going to be $10,000 an ounce because the central banks of the world are going to agree on it, then that's what silver's going to do. But that is a big if.
So again, like Saifedean has convinced me that even if gold comes back, silver is done because you can always. Silver's only usefulness was a micropayment for gold, which with the current technology is just not needed.
Yeah, I I would sort of disagree just on the assumption. I think there's a problem in time and timing with that conclusion. An awful lot of countries still use silver, not as coinage, but as value. And India is one of the best examples of that.
All right, let's jump onto oil, and maybe we'll, if we have a minute, we'll cover some currencies. Someone is asking about a euro versus PLN. I don't know how relevant the Polish currency is to my followers, but time dependent though. Okay, wait, I was gonna go to oil. Let's look at oil. Do I have an oil monthly? I do. Here's oil monthly. Here's oil weekly. I'm not sure if I care about oil daily. We don't do these videos enough to warrant. Looking at oil daily. Wow, it's still going up, huh?
Yeah.
That's kind of amazing. Now here's oil monthly. I remember that bubble. I mean, I was working at Bear Stearns at the time. I mean, I started that job in early 2007. So literally, I was at that job watching the oil go up. Tops on a 9. I'm not surprised. Let me clean it up.
And started up on a 9 too.
Yeah, it did. This drop was epic from 150 down to $35, which we broke. It went down to 26. I really thought this was going to be the top. But then again, you know, the oil sector is starting to boom with sector rotation. At this point, you have to assume a countdown to 13. So it's possible the price of oil can go up to 80, 90 bucks, but I just can't see it breaking 100 again.
Well, to me, oil is really fascinating because gold and things like gold they're very difficult fundamentally to understand. Oil is not. Oil is moves with the economy. When you go into a recession, you find oil prices falling sharply. And yeah, you can get into the reasons, supply and demand for all of that, but basically, it is very sensitive to GDP. And as long as the Trump economy continues doing what it's doing, these prices should continue to rise. Now, if we slip into, if the equity markets surprise us by breaking down here, and we've given you a couple of reasons why they might, but probably won't, then that is going to result in a recession. And that will result in commodity prices in general and oil prices specifically falling sharply. Without that, I think we can expect this to keep climbing.
Yeah, and here's the weekly chart. And according to, you know, Consensio and money management outlooks, you're 100% in. You're at all-time highs. All the moving averages are rising. They're all above each other. And there's no exponential, well, overall there is, but not on the current move. You bounced off your 30-week moving average. On a weekly outlook, there's no fear.
Yep, that's about as good as it gets for a definition of a bull market. One that's not screaming but is retesting the short-term moving average and then bouncing off of it. And on a decent correction, it tests the intermediate moving average and bounces off of that.
Yeah, I mean, we hit a 9 on a monthly chart, hence the 1, 2, 3, 4 candle correction, though it came on a weekly chart. The monthly chart just corrected, most of the month of June. And then in July, or mid-June, it was all systems a go. And right here on last week's candle, weekly candle of a green 2 above a green 1, above the moving average, everything's a go. That's when you get back into oil. Now I actually am tempted to look at the daily chart of oil to see if it could have been timed for a buy the week of June 25th. Oh boy, you may want to be careful with oil today. Look at that beautiful doji giving you a high off a 9. And on a daily chart, there's your potential 9 to get you back into the bull trade. Now, granted, your stop loss gets hit here, and then you're back in the market somewhere on this giant 2 candle.
Yeah. So you would say on this one a 1 to 4 pullback?
Yeah, a 1 to 4 day correction, right? Like I'm not scared at this point because the monthly has just started a new countdown. The weekly is looking just fine. Here's the weekly. The weekly is like on a 3. So I'm looking for a correction the rest of the week. With the 4th of July holiday coming up. I'm just looking for a correction the rest of the week, and then next week should be bullish again.
Looks awfully good to me. That's the kind of thing I think people remember that I said, taking a little off the table on tech, which was the number 1 sector, putting it into the number 10 sector was energy. And this would be a time that I would be adding to the energy because of some doubts that we're having on some of the other sectors. So that's what sector rotation is all about.
Yeah, let me just throw this in here so that next time I have it, and we'll move on. All right, so that's about it for the markets, except, currencies. I don't know how much time we got. Man, I really wanted to hit the pool, but it's all right. I know I got another call in about an hour.
Maybe we should do currencies and interest rates on another show.
Yeah, you know what? That's not a bad idea. Let's save that for later in the week. Currencies and interest rates. Let's glance at Bitcoin one more time. We're at 65.73. Sure, it's possible we can go all the way to 7K, but I don't know. Like this is all temporary. I would not risk any bullish trades unless you have specific strategies of trading to the bull side in a bear market, like Ugly Old Goat does. I don't know if Van Zen does, but I know Ugly Old Goat does. And I personally would just try to time the bearish trades. And in order for me to time a bearish trade, if I'm looking at a 12-hour chart, I would be bearish below this red line of 6,300. Going below 6,300 makes me a bear. Going up to 7,000 makes me a bear for a bearish trade. And worst case scenario for the bears, you go all the way up into the death cross of $8,300 area.
Yeah, I can't argue with any of that. I went from a short-term negative to a short-term neutral. I'm not going to go to a short-term positive because I just don't see it. But I'm not ready to go negative again. So I'm just telling people short-term, we're in a flat area, no trade zone.
All right. I think this was a long video, probably about an hour and a half. And I say we leave it here, and then we'll probably do. Tyler and I will go over currencies on another video. That would be good, currencies and interest rates and the bond markets. That will be a good market pulse video in the very near future. I've been really busy in keeping up with the fundamentals of the stock markets and stuff, but the technicals, in general, tell us all the fundamentals we need. When you get too busy, the trouble you get into is like the overall fundamentals. They don't scare me. What bothers me is when I get so busy is that I miss the known unknowns. It's like you get so busy and you don't realize that, holy shit, I just invested in a sector and there are like the three biggest names are reporting earnings like tomorrow. Or, you know what, I got so busy and the technicals look good and I forgot that the Fed call is next week. So what screws you up sometimes is these known unknown fundamental events. And that is something you should be able to prevent when you are a trader. When you have other responsibilities like a job or travel schedule like mine, YouTube videos every day, a bunch of kids you need to take care of, even though you're at stay at home, let's say dad trading, but you have like 5 kids. So these kinds of things can distract you from the known unknowns. You can never plan for the unknown unknowns. Those are your, 9/11s. Those are your, bank failures, or not even bank failures, like an Enron situation that the average person has absolutely no way of predicting. So these are like the unknown unknowns that can like annihilate your positions. But it's these known unknowns that you need to be aware of as a trader. And people on TV may not prepare you for that unless it's their job to prepare you for that. But looking at technicals should provide you with all the fundamentals you need about how the economy is doing without looking at the economic reports. But speaking of the economic reports, they are known unknowns. So you need to know which day of the month, the inflation or the unemployment is being reported. Unemployment always gets reported on the first Friday of the month. You need to be aware of that, right? So what are your thoughts on, fundamentals versus known unknowns? And people seem to treat these known unknowns as gospel and shutting down technical analysis with these known unknowns. And I think that's kind of ridiculous. And I don't think these people understand technical analysis when they do that.
Yeah, very interesting points. And it sounds philosophical to a lot of people, but it is not. It's just very practical. What is a known unknown to you is not a known unknown to someone else. There's always someone that has access to information, and they act
to them, it's a known known.
That's right. They act on it, and that shows up in price. You leave footprints when you're in the market, and they can be tracked, and they should be tracked. And that's what Tone does. That's what I do. That doesn't mean we don't look at the fundamentals. Quite the opposite. We just talked about a lot of fundamental things that were causing or contributing to price movement. But the point is that go for the obvious. And the obvious is the way people are placing their money before, during, and after events. They don't have to tell you. They don't have to take out a banner. They're leaving their tracks. Follow the tracks. Learn some of the systems. Learn from Tone. He's got all kinds of great information. He teaches all kinds of seminars on it. And that's all you need to do. And then you've just got to stick with it and find the time to do it, or turn to someone that's got the time to do it.
Yep. Thank you so much, Tyler. Thanks for joining me. And hopefully soon we'll do another one of these in the currency space, currency and yield space. All right, guys. Thank you for tuning in. Again, check out toneface.com. Check out, please, if you want to support my work, check out the affiliate section of toneface.com. And if you're going to use any of those products or services, and I will see you all on the next one. Bye, everyone.